Hi friends, welcome to the crash course unit number 13 of ABFM. Chapter name is Corporate Valuation. So let's get started with the first key pertinent question that we have, that choosing the right valuation approach, which is a simple, I am providing you a simple guide through mind map and flowchart. So when it comes to valuing an asset, selecting the right approach is very crucial. But which one should you use? Let's break it down. On one side we have the market approach, as you can see it here. So look at the market approach, look at the recent transaction and recent asset prices. This method compares similar asset considering their size, quality and quantity and some key characteristics, right? So it compare recent transaction, asset price considering size, quantity, quality and some key characteristics. That is called market approach. Second approach we have is called the cost approach. So cost approach focus on the fair market value of the asset minus liability, right? So fair market value of asset minus liability is what cost approach looks at. It is ideal for asset intensive business. So those business which are huge asset intensive, right, holding corporation or when dealing with troubled entity, then cost approach is most useful because it focus on the fair market value, does not focus on the recent asset price or recent transaction, right? And in the market approach I told you now, the comparison method work best, where we compare similar asset considering their size. And the third approach we have is called the income approach. So income approach is thinks about the future. This approach values asset based on the future earning or future cash flow. It's all about calculating NOI, net operating income, and dividing it by the capitalization rate. So you must remember the formula, which formula we use to while using the income approach. So net operating income, NOI, divided by capitalization rate. So it values asset based on future earning or future cash flow. So the three method which we have just learned now, each method has its unique role depending on the type of asset. Like suppose the type of asset is asset intensive business, so we will go for cost approach. And suppose we are futuristic looking, then we will go for income approach, right? So each method has a unique role depending on the type of asset and business situation. So that is the point. So one should choose wisely to unlock the true value. Which one to choose? I hope I have given you sufficient insight. Now friends, let's have a look. So when it comes to valuation, choosing the correct method is not just important, it is crucial. So what are some valuation method selection criteria? So before we choose, we consider the basis of value, right? The pros and cons of each and every methods, that is called advantage and disadvantage, their appropriateness for the situation, how much they are appropriate for the situation, and the reliability of the information available, means whether the information available is trustworthy enough, is it reliable enough. So that is the valuation method selection criteria. Then we have the cost approach, right? What is the cost approach? Let's see the point. So I told you early, in the cost approach it is based on the cost to rebuild or replace the asset. It is already I told you it is for asset intensive businesses, right? So suppose I want to rebuild the asset or replace the asset, how much it would cost me, right? Suppose I have a huge building, right? I want to rebuild it, I want to replace it, right? So how much would it cost me? That is called the cost approach. This is how the valuation is done. It is perfect for valuing the tangible asset, right, where rebuilding is a realistic option. So cost approach is there, it is helpful. Then we have primary methods. There are some primary methods of valuation also. Let me give you a name. I will discuss in detail about this. So the first is called adjusted book value approach, stock and debt approach. We will cover all these things. Direct comparison approach and discounted cash flow approach. These are the four primary method used. And methodology, sometimes a single method is enough, other time multiple methods are needed to ensure accuracy, especially when data is limited or insufficient. Remember, value reconciliation is all about thoughtful comparison, not simple averaging, right? So that is called, value reconciliation. It's all about thoughtful comparison, not simple averaging. So basically this is the a complete overview of the valuation method. So choosing the right valuation approach is not just a step, it is a strategy toward better business decision. Now friends, have a look at this particular flow chart. Very important. It talks about the asset valuation methodology. So friends, asset valuation is a crucial step in understanding the true worth of a business. Let's walk through how different types of assets are evaluated. If you go through the book, you will see multiple lines, paragraph, right? You have to identify yourself what is important, what is not important, and what we do in our crash course, that we filter out the important content for you in the most efficient format, easy to understand, easy to remember. At the last moment before the examination, if you go through such PDF, you will be able to easily recall in the examination all the fact, because mind map work in the same way. Once you hit your mind, you will never forget it. So we have prepared such kind of material for each and every subject. If you are really interested in it, you can enroll in our crash course program. In crash course program, we ensure we provide you such kind of content, right? We are not covering 100% syllabus, rather we are just covering only those part from where questions are being repeatedly asked. Now first of all, let's look at the cash. So cash, the valuation is since there is no change in value, right? Reason is that cash is already at face value, there is nothing to adjust or estimate. Then receivables. So receivable is valuation start with the face value, which means the amount owed, and then adjust for the default risk, meaning you lower the value if there is a chance that some customer may not pay, right? So receivable means what, that suppose you are providing goods or services, some customer takes goods from you, and they said that they will pay you later, right? That is called receivable. So first of all, valuation, you start with the face value, means the amount that is owed, or the amount the customer has owed to you, right? And if suppose some default happens, somebody don't pay, then you have to reduce that amount. You have to adjust for the default risk. That means you lower the value, right? You should lower the value. Then we have the stocks, which is very important. A stock means inventory. A stock here means inventory. So a stock is valued differently based on their production stage. There are different production stages of stock or inventory. The first is called raw material. So it is done at the last acquisition cost, means what it costs to purchase them. That is how the valuation, asset valuation of the stock in the raw material is done. Then we have WIP, or work in progress. So it is evaluated either cost or selling price depending on the reliability of information. And then we have finished good. It is evaluated at selling price minus cost to complete and sell them, right? So three kinds of things we have just discussed: raw material valuation done at the last acquisition cost, work in progress cost or selling price, finished goods selling price minus cost price. Other current asset, so it is recorded at the book value, means the value listed in the accounting book. Tangible fixed asset, if it is land, so it is valued at the market value, the price it would fetch if sold today. If it is building, it is valued on the replacement cost minus depreciation, means the cost to replace the building today less any loss in value over the time. If it is machinery, then we have to add the market price plus cost associated with making it usable or sellable, right? So these are the tangible fixed asset. What about intangible fixed asset, like patent, trademark, goodwill? So they require unique valuation method, like book value, market value, utility to the business, or remaining useful life. There is a separate chapter for valuation of the intangible fixed asset. And finally we have non-operating asset, means those assets which are not used in daily operation, like suppose surplus land is there or unused building is there. So they are valued at the market value, means what they could sell for currently, right? Like securities, surplus land, disused structure, etc. So basically each type of asset has a tailored method for valuation depending on its nature, whether it is liquid cash, evolving inventory, valuable property, or even intangible intellectual property. Correctly valuing asset ensure accurate financial reporting, better investment decision, and fair business evaluation. Now friends, have a look at the first approach. I told you na, stock and debt approach, very important. Every aspect which we are going to clear here. So when valuing a company, one trusted method is the stock and debt approach. If you look at the definition, so it is simple. Just add the market value of equity and the market value of the debt. That is your total company value. That's so simple. Market value of equity plus market value of debt. That's it. Now assumptions. What are the assumptions that it made? Very important assumptions. See, this method work on EMH. What is EMH? Efficient market hypothesis, which says that market price already reflect a company true worth. That is called efficient market hypothesis. That it says that market price already reflect a company true worth. For example, let's take a Seashore Limited. As on 31st March 2022, the data is given that equity is 15 lakh share and price per equity is 50 rupees. So it amounts to 7.5 crore. Similarly, debt market value is 14.8 crore. So the total firm value will be 22.3 crore. That is what it says, which says that market price already reflect a company true worth. So this is the market price. It reflects the company true worth. Right, that is the example. Now there is some controversy regarding it. What is the controversy? But there is a catch. Should we use current market price or an average price? Right. So EMH suggests current market price is the best. What is EMH? EMH, you know, I told you the formula of EMH, efficient market hypothesis. So EMH says that use current price, right? But because averaging can reduce valuation accuracy, because if you multiple average, then it will reduce the accuracy, right? Valuation accuracy. So what is the key implication, key takeaway? That you know that if the market is efficient, the stock and debt approach is reliable. Always use lean data prices, not average price, for the most accurate result. So the stock and debt approach shows us the power of market signal, but it needs a keen understanding of the market efficiency to get it right, because everything depends on the market. What is the market value of equity? What is the market value of debt? Then only you will add them now, right? So this was all about the what we have just discussed is the stock and debt approach. The second approach we have is called DCM, direct comparison approach. So when it comes to determining the true value, direct comparison is one of the most straightforward method, right? What is the principle? It works on the principle of substitution. Simple idea, substitution, that no buyer will pay more than what it costs to buy a similar competitive property, right? So no buyer pay more than cost of a similar competitive property. Very important. This is a principle. Now if you look at the steps involved, first determine the highest and best use of the asset. That is called HBU. HBU means highest and best use of the asset. Next, identify the comparable sale, means similar transaction. You find the similar transaction and then you adjust the sale value based on the difference. So 3-step process I told you. HBU means highest and best use of the asset. Then identify the comparable sale, means find similar transaction, and finally adjust the sale value based on the difference, right? So these are the 3 steps: HBU, comparable sale, adjust the sale value. Now if you look at the methods, so here we have the methods. The focus is to find similar business or asset and use current market price for accurate reflection. So that is the focus. The focus is to find similar business or asset and use current market price for an accurate reflection. If you look at the comparables, so the trick is that minimal adjustment, right? The closer the comparable, the better the valuation and higher the accuracy, right? The closer the comparable, the better the valuation, the higher the accuracy. And if you talk about the adjustment, so what is the adjustment? First, perform a time adjustment, means aligning old sale to the current value. Then apply any other necessary adjustment, but always adjust on a per unit basis, right? So in this valuation, the direct comparison approach reminds us that real world comparison, when done carefully, it creates the clearest path to the true value. That is why I told you HBU is done. HBU means highest and best use. We identify comparable sale, find similar transaction, and finally adjust sales value. Adjustment is done, sometimes time adjustment is done, right? So means aligning old sale to the current value and apply any other necessary adjustment. So these are the steps, complete steps. regarding the direct comparison approach. And in the our in our theory video, I have provided a numerical problem also based on a step by step explanation of how to go about solving a problem based on direct comparison approach. It is not feasible to describe the entire process here, because the entire calculation will itself take 20 to 30 minutes. So I request you to please go through the theory videos. Now friends, let's look at the financial performance overview, some very important metrics which are very important role. So let's break down the terms one by one. First of all, the invested capital. Imagine a business need money to buy machine, building or other resources. Invested capital is the total money that come from shareholder, that means owner, and the lender, which means bank or investor, to buy all kinds of asset, whether they are using daily or just sitting there, right? So that is the point. The invested capital means whatever fund that has been accumulated from the shareholder or the lender like bank to buy all kind of asset. This is called the invested capital. Then we have operating invested capital. This focus only on the part of the business that are used day to day, daily run operation. Means it focus on the part of the business that are used daily. It includes machine, factory, working cash, basically everything that help the company make and sell product. That is called operating invested capital. So the formula is quite simple, that operating asset plus operating working capital. Now what is this operating working capital? This is short term money movement. That is why working capital. It is the money tied up in everyday operation, like buying inventory, stock, or waiting for customer to pay, receivable, or paying supplier, that is called liability, right? So the formula is operating asset, which means cash in. You can see the formula, operating working capital asset, which means cash in products, means bill minus bill we owe, that is cash out. So cash in minus cash out, that is very very simple formula. So non-interest bearing current liability means these are the bill which we owe, that is called cash out, which we have to pay. And operating asset means cash in, means some product. I told you means some money is tied up in everyday operation, that is cash in, right? And cash out, this tells us how much money the business need daily to run smoothly, right? To run smoothly, how much money the business need, that is called operating working capital. Formula is quite simple, operating working asset, right? And minus the bill, non-current interest bearing current liability. Then we have NOPLAT, net operating profit less adjusted tax. Fancy name but simple idea. It is the actual profit the company made from running in business after paying the normal tax. So after doing business and paying tax, how much real money is left? That is called NOPLAT, right? So after doing business, after paying tax, how much real money is left? So that is called NOPLAT. The formula is quite simple, EBIT, earning before interest and tax, minus tax on EBIT, that is called NOPLAT, net operating profit less adjusted tax. What is EBIT? EBIT, earning before interest and tax. So this is the interest, this is the income the business made before paying off loan, that is the interest before paying out government tax. So it has not paid interest, it has not paid government tax. The total income it has made, the company has made, is called EBIT. It shows how much the core business earned before any extra cost comes into pay. For example, if a bakery make $10,000 before paying tax and bank loan, that is their EBIT. And what is the tax on EBIT? These are theoretical tax a business would pay if they had no loan, no extra cash lying around, no weird gain or loss. It gives a pure view of tax impact on operating profit. So in short, if we summarize these 5 kinds of parameter which we have just gone through, let me summarize it. Invested capital, get the machine running. Operating invested capital, right, it powers daily work. Of working capital keeps cash flowing. EBIT, so earning before outside cost. NOPLAT, so real business profit after tax. And tax on EBIT is what the taxman theory takes, theoretically takes. Now one more important parameter is ROIC, right? So what is ROIC? So at the heart, ROIC stands for return on invested capital. The formula is NOPLAT upon operating invested capital. NOPLAT I told you, that is EBIT minus tax on EBIT, and operating invested capital already I told you here, right? This the formula regarding it, that is operating invested capital here, operating asset plus operating working capital, right? So just write in the denominator, you will get ROIC. So it measures how much profit a company generate for every dollar invested in its operation, right? So that is why in the denominator we have operating investment, means every dollar we have invested in the operation, how much profit the company generate, that is called ROIC. Now while calculating ROIC, consistency is the key. Use either the beginning or the ending or the average value for your investment, but whatever you choose, stay consistent between the numerator and the denominator. Then only your result will be consistent, accurate and reliable. Now then we have the net investment. It is the amount a company actually spend on new asset after accounting for wear and tear. So how much amount the company invest on new asset is called the net investment. It is equal to gross investment minus depreciation. Just like net salary is equal to gross salary minus deduction. Similarly, what is gross investment? It is the total money spent on both current and long term asset, everything from buying machine to upgrading technology. And what is depreciation? Over the time asset lose value. Depreciation is the non-cash accounting method that reduce the book value of asset every year, reflecting this gradual loss. So there is alternate formula, that net fixed asset plus net current asset at the end of year minus net fixed asset plus net current asset at the start of the year. This gives a full year picture of how much net investment was made. So in short, ROIC tells you how smartly a business is investing in capital, while net investment show how much real investment is happening after accounting for asset aging, right? So that is all we need to understand from this particular chapter examination point of view. Many things are there, right, which you can go through, but from examination point of view, if you cover this much, more than enough. Thank you.